Welcome to week 9 of our module. The topic for this week is integration of financial statement analysis techniques. We learned the framework for financial analysis in week 1 of this module. The framework for financial analysis involved 6 steps: defining the purpose for the analysis, collecting input data, processing the data, analyzing and interpreting the processed data, developing and communicating conclusions, and then the final step was following up. We will use the financial statement analysis framework in 3 different scenarios to assess financial performance and position. The first case study here is that of a long-term equity investment in Nestle. A portfolio manager for food sector of large public employee pension fund is desiring to invest in Nestle in long term. The investment will be in shares. In the 2007 annual report, Nestle has outlined its long-term objective as organic growth, continuous margin improvement, and improvement in return on invested capital. The portfolio manager is interested in answers to the following questions. What are Nestle's sources of earnings growth? How sustainable is Nestle's performance? In other words, do the company's reported earnings represent economic reality? Can the capital structure of the company support future operations and strategic plans? The portfolio manager is also interested in knowing how well Nestle's balance sheet takes into account the company's full rights and obligations. That is, does it reflect off-balance sheet assets and liabilities as well? Therefore, the portfolio manager has requested the financial analyst to perform a thorough analysis of Nestle. The objective is to determine the suitability of Nestle for a long-term equity investment by the pension fund. In line with the framework of financial analysis, in the first phase, the analyst articulates the purpose and the context of the analysis as isolating the factors that have driven the company's financial success and assessing their sustainability. At the same time, the analyst has to delineate and understand the risk that may upset the sustainability of returns in the long run. In the second phase, the analyst identifies the different sources of information on Nestle and obtains the financial reports and financial statement data from the website of Nestle and other sources online. Phase 3 of the framework of financial statement analysis, the analyst intends to accomplish the purpose stated in the first phase through a series of financial analysis. These include a DUPONT analysis for Nestle, an analysis of the company's asset base, an analysis of company's capital structure, a study of the company's segments and the allocation of capital among them, an examination of the company's accrual in reporting as they affect earnings quality, a study of the company's cash flow and their adequacy for the company's continued operations and strategies, and finally, decomposition and analysis of the company's valuation. Let's have a look at some of these analysis that the analyst has performed. 3 detailed analyses are available in the final chapter of the book, that is your recommended text. If you are interested to see that, just read it from the book. The DuPont analysis show an increase in the return on equity over the 3 years from 2005 to 2007, and we can see that the net profit margin has been improving over these 3 years, and we also note that the asset turnover, that is the efficiency of the firm in utilizing its resources, is also showing an increase. In the same period, we observe that the leverage of the firm has declined from 2.16 to 2.02, which is implicating lower financial risk. The results from DuPont analysis are consistent with the stated long-term objective of Nestle of continuous improvement in margins and return on capital. Nestle has 30% stock ownership of L'Oreal. Now, this may affect our findings from the DuPont analysis because the investment in L'Oreal affect not only the total assets but it also affects net income. Therefore, we need to subtract net income and net investment in L'Oreal from Nestlé's total assets as well as net income to calculate the return on equity that is free from this bias. Here we have the return on equity for Nestlé as we calculated on the previous slide from the DuPont model. We calculate the Nestlé only return on equity where we have deducted the net income and net investments attributable to L'Oreal from the net income and total assets of Nestlé as we used in the previous DuPont analysis. Even after adjusting for this, the Nestlé only ROE shows an increasing trend over the 3 years period. This implies that the improved performance observed in the first case is not attributable to L'Oreal, as we can see that the associates contribution, that is L'Oreal's contribution towards ROE, has dropped from 0.82% to 0.77% in the 3 years. If financial statements are prepared under different accounting treatments over the years and these are to be compared, the comparison may be biased. Therefore, necessary adjustments must be made to keep the analysis logically consistent throughout the analysis period. To analyze capital structure, one approach is to use common size analysis. Here we have the Nestlé's long-term capital structure analyzed using common size analysis from the year 2004 to the year 2007. We see that in 2004, the long-term financial liabilities were 18.4% of total long-term capital, and this have declined to 8.6. This reflects a deleveraging effect where the leverage of the company has gone down over the 4 years period. Other long-term liabilities have remained relatively stable while total equity has increased as a percentage of the total long-term capital. Deleveraging results in improving the leverage of the firm. However, it also leads to deteriorating liquidity. The deterioration in liquidity can be offset by improvement in the management of accounts receivable, inventory, as well as payable, and this may help to mitigate the related decline in the actual working capital of the firm as a result of deleveraging. A business segment is a portion of a larger company that accounts for more than 10% of the company's revenues or assets, and it is distinguishable from the company's other lines of businesses in terms of risk and return characteristics. Segment analysis help identify the most profitable business segments as well as identify the segments that contribute more towards the total revenue of the firm and the total profitability of the firm. In addition, it also helps in identifying the least profitable or least efficient segments as well as identify the segments that have geopolitical investment risks. To determine if Nestlé is allocating its capital across different segments efficiently, an analyst may rank the different segments based on their EBIT margin with respect to their individual ratio of capital expenditures proportion to total assets proportion. A ratio of less than 1 indicates that the segment is being allocated a lesser proportion of capital expenditure than its proportion of total assets. A ratio that is greater than 1 indicates that the company is growing the segment. Comparing the ratios with the EBIT margin will enable the analyst to determine whether the company is investing its capital in the most profitable segments or otherwise. The 7 segments of Nestlé have been ranked here based on their EBIT margin, with Pharma having the highest EBIT margin of 33.27% and Nestlé Waters having 8.18% EBIT margin. The ratio of Nestlé Water's capital expenditure proportion to total asset proportion is consistently higher than 1 and increasing over the 3 years period. This shows that Nestlé is increasingly investing in Nestlé Waters. However, its return is relatively lower compared to other segments. If Nestlé continues to allocate capital towards such lowest margin business segment, the overall corporate returns may also be negatively affected over the long run. Next, we look at the earnings quality of Nestlé. Earnings quality is concerned with the persistence and sustainability of a firm's earnings. To evaluate the earnings quality of Nestlé's earnings, we analyze its accruals. Accrual ratio fluctuations indicate the use of accruals to time earnings. There are two accrual ratios that we are going to have a look at. The first ratio is balance sheet based, and it is calculated as the change in the net operating assets during the year divided by the average net operating assets. Cash flow based accrual ratio is calculated as net income minus the difference between cash flow from operating activities and cash flow from investing activities divided by the average net operating assets. Both these ratios for Nestlé have been calculated from year 2003 to year 2007. The balance sheet based accrual ratio is volatile, however, it shows an increasing trend overall. However, on the other hand, the cash flow accrual ratio shows a steady increase over the period of time. Now, the pattern of changes and increases in the cash flow accrual ratio is not consistent with that of the balance sheet based accrual ratio. This is suggesting that the company is trying to time its earnings. To assess earning quality, the analyst must study the company's cash flow and its relationship with net income. It must be assessed that whether operating earnings are backed by the cash flows or these are just mere accounting numbers. The analyst has to make appropriate adjustments to keep the comparison between cash flows and earnings consistent. As operating income includes both interest and taxes, therefore the analyst must add the cash paid for interest and taxes to the operating cash flow. This will make the operating cash flow now comparable to the operating income for a comparison purpose. This second adjustment is now no more relevant given that it was way back in 2003-2004. Also, examine the relationship between operating cash flows and total assets. Total assets represent the sum of resources that are available to management. Comparing the cash flow with reinvestment, debt, and debt servicing capacity will result in enabling the analyst to ascertain whether the company has adequate resources for its reinvestments and growth, and whether the company will be able to borrow additional money in case there is an investment opportunity.